Today, I'm gonna share with you a strategy that I've never shared before, never talked about it. And I don't hear a lot of people mentioning it on social media right now or on YouTube. This is an old school strategy, you could say. I used it many times for many years. I made hundreds of percents with many stocks using this strategy, and it has the potential to return thousands of percents over the long term. I'm gonna give you the strategy, I'm gonna tell you the stocks, give you examples, tell you how to find similar stocks, all of that stuff, all in this one very short video. And a lot of you guys know me, I mostly analyze stocks. I don't give you certain value around how to find stocks, how to do all those things. So this is going to be an extremely valuable video. You have to watch the whole video. And if you do enjoy it, all I ask from you, if you could please press the like button, it will help me very much. And maybe leave a comment if you agree with me, disagree with me. Let me know what you think in the comments. Okay, now in the stock market, you have something called a moat or an economic moat. You could say of companies like Google, Apple, Amazon, even stocks like Visa. And a moat is very important because it keeps competition away. And the worst thing you could have is a company with no moat, that the competition is just gonna come and eat you alive, and you're gonna go from increasing revenues to decreasing revenues or declining in profitability in general, and you just pretty much go to zero, like what happened with Tupperware. Tupperware has no moat. Look what happened to the stock. I believe it went pretty close to zero. It was an iconic brand. It went to zero. Why? Because the company had no moat whatsoever. And a moat is very important in the market. But the problem is right now, because of social media, because of everything else, especially in the United States, because people love US stocks here in the US. The problem is that a good company is well known and they're wide, they're just huge. And because they're so well known, they get priced to perfection. And they are great companies. But everyone else knows that they are amazing companies. They are just stunning. Visa and all of them, they're amazing companies. But because everyone knows it, it's priced to perfection. So this would leave you with very little room to generate returns. Now, I'm not saying that you can't. Look at what happened with Meta. Meta went from like $300 to like $89. So such stuff do happen from time to time. But most of the time, if you do buy the wide mode companies at 20, 30, 40 times earnings, and everyone knows they're wide mode companies, you're very rarely going to make amazing returns in the market. Now, the good thing is there is a solution to this problem, and this is mainly an alternative strategy. And I did learn this strategy, it's not mine. And I heard Pabrai talk about it, Monish Pabrai, a lot of you know him. This is his YouTube channel. I watched a video of his like 5 or 6 years ago, and he was talking about a guy I haven't heard of before, and he was Guy Spear. I just didn't know the guy. And he apparently him and Pabrai, they went to lunch with Buffett before, and he wrote a book, something about a value investor or the making of a value investor, I think it's called. So he's a good fund manager in general. And Pabrai was discussing Guy Spear's strategy. And he was talking about how he loves wide mode company. Pabrai is more of a value investor, just he goes into turnarounds. But Guy Spear, he just loves the wide mode companies. And for wide mode companies, this is a good list you could look at from my X account. And as companies, you could say like LVMH, this is a wide company. Maybe MSCI is a wide mode company. Maybe Nvidia is a wide mode company. O'Reilly's, which sells auto parts in the United States, amazing business. Or maybe a company like S&P Global. S&P Global is a rating company in the United States. A lot of you watch The Big Shorts. Maybe you remember Moody's, you remember S&P, you remember Fitch. Those are the 3 largest credit rating agencies in the United States. And even 2008, which was largely caused by them assigning the wrong ratings to, there was very bad debt, they assigned good ratings. And was largely due to them. And they're still alive today, and everything is fine. So this is a very wide moat, an amazing business model that cannot be destroyed. Stunning. And so that has to have rating on them. You need the credit rating agencies. It's an amazing business model. But if you look at S&P Global or Moody's or Fitch, even Moody's, I believe, is trading at 40 times earnings or 42 times earnings, and it's not growing that quickly, like 5 or 6% in EPS. It's extremely overvalued for this company. Now, Guy Spear, he found an alternative to the problem. As he looks for very wide mode companies in the United States, and he tries to find the same kind of companies in other countries where they haven't been discovered yet. Because everyone knows in the United States, Moody is a company. Maybe there's another company in another country where it has the same mode, the same everything, but it's trading at 70% of a discount because over there, maybe they haven't realized how amazing of a business this company is as of yet. And this is how Guy Spear found a stock called Crystal. And Crystal is pretty much whatever S&P is in the United States, the rating agency. Crystal is in India. Way back, I believe he was in 2007 or 2008. It was a while back. I forgot where he started buying it. But he did buy the stock. The stock did amazingly well. And then it went up, he sold it and it went up like 2,000% since he sold the stock. But he did amazing, like he made 600 or 700%. And the best part is Crystal, around 66% of it owned by the S&P in the United States. So S&P knew it was a great company back then, but back in India, they didn't know it was such an amazing company. It wasn't so well known as the credit rating agencies in the United States. And this is what caused the massive gap in valuation. And eventually the gap was closed and the stock returns thousands of percent over the last few years. It's a pretty amazing strategy. And I tried to implement it myself. And I like, for example, waste management. I like management stocks in terms of waste and garbage. I think it's a very predictable industry. But the problem is in the US, they're trading at 28, 29 times earnings for waste management. So I started looking in other countries for waste management stocks. It was actually last year. And I found a stock in India called Anthony Waste Handling. And it was trading at 15 or 16 times earnings with the same business model, same mode. And it was in India. But because I'm a US citizen, I couldn't buy it. I tried everything, I couldn't buy it. And I told a lot of people that watch my channel from India, I told them in the comments, check out Waste Handling. And the stock is up 100% since last year. It got discovered, and people now realize it's such an amazing company and will likely keep going up over the long term. Now, I'm going to tell you how I modified the strategy for myself and how I implement it in my own portfolio, and I have had success doing so. I took it one step further, where I don't really want to look for wide mode companies only. I want to look for certain trends and something that got realized or something that's overhyped here in the United States. And I want to try to find it somewhere else that's trading at a massive discount with the same fundamentals, same tailwinds, and same everything pretty much. And this is how I came across the construction industry or the infrastructure boom in the United States. I saw some population growth due to a lot of migration. And I saw the company, and I should say the government, investing in infrastructure. And hedge fund managers got caught too late on this trend, and they FOMOed into these stocks. So this is a company, for example, is called VMC, Vulcan Materials. I believe they put up concrete and asphalt. It's up 67% over the last 5 years. United Rentals, where they rent the equipment, the lifts, and all that stuff. It's not the best business model ever. It's up 600%. Quanta Services, this is mainly some kind of a construction company for infrastructure. It's up almost 700% over the last 5 years. And those companies are trading to perfection. This asphalt company, Vulcan Materials, is trading at 30 times earnings. It's not even growing that fast, at 30 times earnings. This is what happened. Another one, Quanta Services, is trading around 32 times earnings for a construction company. Before it got discovered, it was trading at 11 times, 11 to 12 times, because hedge funds caught up to the trend of infrastructure spending. Quanta Services went from 11 times earnings to 31, 32 times earnings. So I started looking around. I'm like, where do I see a country that's pretty close, that has some population growth and has old infrastructure, and the government is investing in new infrastructure and in many different projects or in housing? I need to find the same kind of tailwinds, the same sectors, but with cheaper stocks. And this is how I came across a stock that I talked about it in this video, which is called the best investment opportunity nobody is talking about. And this stock was Bird Construction, which is a construction company in Canada. It's right here across the border. A little bit of a different currency. You could have bought it even on OTC if you wanted to. But it's the same tailwinds. They're investing in infrastructure. They have migration. They have a population boom. Population is starting to increase. GDP is following along. They have a housing problem. They want to build apartments. They're giving incentives. Bird is building nuclear facilities, is building apartments, is building many different things. So I saw the same trend, the same of everything. But back then, now, for example, Bird is up 42% over the last months. Year to date, it's up 124%. I'm up 70% on the position that I bought in March, around $16.98 or 16.99 it was, around $16 range. And since then, Bird, even though it's up so much, it's still trading at 13 times earnings. When we bought the stock, it was trading at 7 times. Actually, our 9 times earnings was around March, around 10 times. 10 times earnings when we bought Bird, and it went as low as 9 times, or 9 times free cash flow. Now it's still trading at 13 times earnings. And as the trend continues, as a lot of funds they start discovering this trend, the same thing in the United States, in Canada, I wouldn't be surprised if Bird goes to 20, 25 times earnings. And the company is still growing 50% earnings per share. 50% EPS, and have a 2-year backlog and is still trading at 13 times earnings. This is an example of how I applied this strategy in finding opportunities in other countries with the same exact setup, same exact tailwinds, same exact fundamentals, but at a much cheaper price before the trend becomes so obvious to hedge fund managers that construction is going to be booming over the next 5 to 10 years, and they're catching up to this trend. And I believe this trend, for example, is only getting started. Now, somewhere else where I've been finding a lot of opportunities, I did buy a stock like last week, and I'm looking for more, is in Mexico. And this is, again, across the border. It's now the largest trading partner of the United States. And the entire ETF over there is trading at 10.9 times earnings. And this is not because the country has bad fundamentals. They're growing rapidly, good demographics in Mexico and Latin America. And you have companies over there comparable to the moats of US companies, but they're trading at 15, 14 times earnings. And in the US, they're trading at 30 and 35 times earnings. And you can search them. For example, you can look at the wide moat list that I have, or anything. Let's say, for example, you like railroads. For example, railroad stocks in Mexico. Maybe it just went down with all the stocks because they have a new president, but the railroad is still here. It's not going anywhere. So maybe you could buy this railroad at 10 times earnings, and compared to the US, it's trading at 25 times. Maybe you could find some value over there. For example, put railroad stocks in Mexico, railroad stocks in Europe, railroad stocks in Asia, and start going on Google, start researching them, and you're gonna find a gem or two. And this gem has the potential to return thousands, if not tens of thousands of percent over time if you find the right stock and you do the research. That's what I try to do, and that's how I mainly do it. And I use Interactive Brokers to buy them, which I have a link in the description if you want. And they mainly give me currencies. I could transfer currencies and buy any stock in the world, except in India, unfortunately. But that's how I do it. This is how I select stocks. And I share everything I do in my own group if you're interested. And this is all I have. I hope you enjoyed this strategy. I hope you liked it. Maybe you disagree with me. If you do agree with me, just let me know what you think in the comments. I really want to know your opinion. But thank you very much for watching this video. I really hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.